Hello to everyone. Today I am here with a new concept related to the financial matters, that is time value of money. If you are interested to have update videos on banking and finance related topic, please do subscribe my channel. First of all, I am going to define time value of money. Money received today carries more value than the same amount received in the future. Why? Money received today carries more value than in the future. It's one of the very major questions. If you purchase a pen today for value 100, the value of same pen may increase to value 115 in future after 1 year. It means the value of asset, that is pen, increased by 15% over a year time. The value of currency is depreciated. So over the period, currency used to be depreciated, particularly in case of a developing and underdeveloped country. The increase in the price of the product is called inflation. To keep the value of currency at par, the central bank adjusts the interest rate, or that is called policy rate, as a part of their monetary policy. The central bank used to review inflation and other factors from time to time in order to adjust their policy or interest rate. Change in value based on two factors. One is the time, and the other is the appreciation or depreciation rate of the currency. For example, Mr. X invests 600,000 in 5 years maturity financial asset. Financial asset can be term deposit, bond, etc. And expected rate of return equal to 19%. Calculate its maturity value by applying simple interest and compound interest method. What is given in the question? First of all, investment value at time zero. Zero is the time of the investment. That is represented by PV zero. That is equal to 600,000. Maturity period is for 5 years. So the N will be equal to 5, and the rate of return, that is represented by K, is equal to 19%. Now we have to find its maturity value, that is future value, and N is 5, so the uh, FV 5 is to calculate by applying the simple and compound interest method. First of all, we are going to apply the simple method. FVN equal to PV naught plus PV naught multiplied by a term, that is N, and multiply by its rate, that is K. So it comes to 1,170,000. Now here we are going to apply another, we are going to discuss another important term, that is periodic payment. Particularly in case of a simple interest method, periodic payments are payments make more than one in a year, like semi-annual, quarterly, or monthly. If term is 3 years, payment made is semi-annual, therefore n is equal to n multiplied by m. M represents two semi-annuals within a year. So the total payments come to 3 multiplied by 2 equal to 6. In case of a quarterly, the n will be equal to 3 multiplied by 4, because there are 4 quarters, and the total payment for 3 years comes to 12. In case of a monthly, the total payment within a 3 years comes to 3 multiplied by 12 equal to 36. Now we are going to calculate the effective rate of return in case of a simple interest method. If the annual rate is 12% and payment are semi-annual, in that case, 1 plus K will be divided by M. M is 2, and N will be multiplied by M. M is also 2. So here 1 plus 0.12 divided by 2 and power 2 minus 1 comes to 12.36, 36. So in case if you are receiving payments, profit payments on semi-annual basis, it means your effective rate of return is 12.36, whereas the annual rate is 12%. In case of a quarterly, that is calculated and comes to 12.55. It means it's increased by 0.55% in case you are receiving the profit payment on quarterly basis, and similarly if you are receiving the payments on monthly basis, it comes 12.68%. Now we are going to apply the compounding method on the same question, where FV1 is equal to PV naught plus PV naught multiplied by N multiplied by K. So it comes to PV naught is equal to 600,000, and for first year the future value comes to 7,14,000, and for the second year the future value of first year becomes the present value for the second year. This concept is also called interest on interest. Therefore, for the second year, formula comes to FV2, that is equal to PV1 1 plus N multiplied by K. The answer comes to 649,660. Here FV2, it becomes the present value for the third year. For third year, it comes to 10119,954. Similarly, for the fourth year, it comes to 1203,203.5, and for the fifth year, it comes to 1431812.20. Now, if you have to calculate for 20 or 30 years, it becomes very difficult. So we are going to develop a formula in order to simplify the solution of this type of the question. We have FV and PV naught plus PV naught multiplied by N multiplied by K. It is equal to PV naught 1 plus N multiplied by K. N is 1 for single year calculation. For first year, it comes PV naught 1 plus K. For second year, we have F2 PV1 1 plus K. Now here you are going to put the value of, here we have you are going to put the value of PV1. You are going to put the value of PV1. The value of PV1 is 1 plus K. Here you can see FV1, it is equal to PV1, and the value of PV1 comes to PV naught 1 plus K. When the bases are same, the powers will add. So FV2 equals to PV naught 1 plus K2. Similarly, for third year, the answer comes PV naught. Here we put the value of PV2. Here we have the value of PV2, that is PV naught 1 plus K2. So we have placed this value here. Answer comes to PV naught 1 plus K power 3. In the similar way, we have seen that when we have FV1, the power comes to 1 plus K power comes to 1. When we have FV2, power from 1 plus K comes to 2. When we have FV3, power comes to K plus 1 power 3. So here if N is 3, here the power is 3. It's the similarity. The formula comes to PVN. Here the power will come 1 plus K power N for nth year. Now we are going to solve the same question by applying this formula. Here we have the maturity value, where here we have to find the value for PV5. Initial investment is 600,000, term is 5 years, and rate is 19%. We have the formula PV5 equal to PV naught 1 plus K power 5. PV naught is equal to 600,000, the rate is 19%, and the term is 5. Answer comes to 1431812.20 by applying the formula. So we can see, we can compare this answer with the answer we have solved manually. answer that same. So in future, you can apply this formula for the calculation for a long period calculations like 30 years, 40 years or plus period. Thank you very much. See you again with the upcoming video on the same concept, that is time value of money.